There is simultaneous evidence in turbulence.
Priorities. The repercussions. I think there is an echo.
most vulnerable countries. And maybe just conclude from a rating perspective, we focus not on the one-time increase in debt, but on the medium-term sovereign credit implications. And they will depend on the ability of countries to stabilize debt trajectories.
May I ask who are not speaking, please?
Yeah. So one last point I just wanted to make to conclude is from a ratings perspective, we focus not on the one-time increase in debt, but on the medium-term sovereign credit implications. And they will depend on the ability of countries to stabilize the debt trajectories in the years ahead and ahead of future shocks. So I'll stop here. Thank you.
Elena, thank you very much. You have raised important points. I will come back maybe in the second round, but let me now go to Rafael. Rafael, many are comparing the situation today with the taper tantrum, especially that people are very worried that any change in market, any increase in interest rates would lead to massive capital outflows. We saw a small move in terms of capital flows earlier this year. But let me ask you, if we compare to 2013, what is different between the playbook of 2013 and now? And what should be what are your recommendations to both issuers and investors on that front? How do you see the lessons of 2013 playing or helping in 2021?
Thank you, Jihad. That's a really good question. And before I actually answer the question, I think I'm going to provide a couple of context to the answer I'm going to give, because obviously there are some parallels, but there's a massive difference between what happened with the taper tantrum of 2013-14, what we're happening now. So I'm just going to quickly share my screen because I want to just show a couple of things to put things into perspective. So hopefully everybody can now see my screen. Is that correct? Or not yet? Here we go. Hopefully now everybody can see it. So as you can see, the reason why I accepted to talk today, Jihad, is because I think that sovereign debt management practices must continue to be enhanced in order to be able to respond to what we're seeing today. And I think that in order to put that into context, I want to say that, what I do is that for the last 20 years, working with new state partners, we specialize on providing debt management services to sovereign governments and central banks, particularly in times of economic distress and financial stress situations. And what we focus on is defining and implementing liability management strategies to optimize their service profiles. And I have spent the last 20 years working with governments around the world, dealing with when external shocks hit and dealing with those situations. Now, what is interesting, what is very different here really is the impact of, like Elena was explaining, the long-term impacts of the pandemic. So governments across the globe, regardless of the development and income levels defined by the World Bank, for instance, have been forced to implement unprecedented emergency financial measures to contain and address the impact of COVID-19 on all facets of life. At the same time, you're seeing sources of tax revenue collapse, foreign currency depreciates, and massive dislocations on all aspects of domestic and the global economic market. So the need to mobilize financial resources to address those rising needs, social needs, and the strengthening social safety nets really is pushing public sector debt levels to unprecedented levels across the globe. And we see that, and I actually didn't spend a lot of time looking at the numbers because I thought Elena was going to raise them, so apologies for that. But we're talking about on the scale of over 300 percent of global GDP. And I think it's never been like that in the history of this world. And so it's creating significant financial stress and really is threatening a wave of potential sovereign defaults. And many governments, particularly those across the low-income world, including the MENA region, could be at high risk of debt distress, and because their debt servicing capacities are, if not collapsing, they're rapidly deteriorating. And we already seen around the world that a lot of governments have already defaulted on their contractual obligations. And now there are really concerns among market participants, particularly investors, that many other sovereigns will actually need to follow suit and will be forced to restructure the sector positions. But what is interesting is that what you've seen is that some governments have been able to address the market to raise funding. There's an addition, we have the multilaterals providing a lot of support. The IMF is coming up with reallocation of the SDRs. We also see the DSSI, the Debt Service Suspension Initiative that was initiated with the G20 that provided 73 countries, very low income countries, with some resources to be able to reallocate that to deal with the pandemic and the impact of the pandemic on healthcare systems as well as unemployment and so forth. And now we're talking about something more comprehensive as a prevention, looking at what they call the G20, what they call the common framework if they need to restructure their debts. So we are facing very unprecedented terms, and and when we looked at the taper tantrum, we were looking at a normalizations of monetary policy around the world that never really happened. What we have now is we have a world living in a very different situation, and like Elena said, with repercussions that we yet to be seen across the world. And I just have in this slide, I wanted to highlight some of the themes that we are seeing that are coming out of the pandemic. So what is interesting, like we just said, is the level of sovereign debt is at unprecedented high levels, and the global stock continues to increase. And that's doing huge amounts of risk management pressures on sovereign debt managers and on the countries, sort of the way they implement monetary policy and sound policies. And what is interesting is that we have massive accommodation in monetary policy across the developed countries, Japan, the United States, Europe, the UK, Canada. They're massively, even though right now you're seeing a retrenchment in that for some countries, the money that's still there. But sovereign spreads are increasing. So that means that investors are differentiating between, even though there's massive liquidity, they're not just buying any debt. So it's making it more difficult for these countries to be able to raise. So you mentioned that one of the themes of this conference and this webinar is how to preserve market access. And that's the reason why I think that sovereign debt management is one of the most vital policy criteria that governments need to strengthen and continue to adopt. The other mention is that payment capacity is deteriorating, and that's not just on developed countries, but also across the world. And the prospects for sovereign debt restructuring is becoming quite real. We already saw many countries, Argentina, Ecuador, Zambia, Suriname, Lebanon, of course, in the region, that can no longer afford to pay their debts and have to restructure. Some haven't restructured, some have already started to begin those discussions, but we have a long way to go. And there's a lot of concern about other countries there. And finally, my last point that I'll say is that when we're looking at how the world is changing, the sovereign creditor base has changed dramatically. We used to move from official creditor lending to more bank syndicated loan lending. Then we saw in the 1980s, 1990s, basically the evolution of more market instruments like bonds and treasury bills and so forth, and the internalization of those because of of how the globalization is taking place. But now there's a big change, big shift, and we've seen that non-parastop creditors, what we call China and some countries in the region, in MENA, for example, Saudis and Kuwait, now becoming much more prevalent lending because they're exporting more and they're providing that support. So we've seen that is changing. And if there's a debt restructuring because of concerns, that's going to be more difficult for countries to address those issues. That's the difference between the two worlds, and also why sovereign debt management is more important now than ever before. Thank you, Jihad. I'll stop there for now.
Sir, thank you very much. Let me turn to Amer. Amer, from where you sit, you see all the spectrum of sovereign and emerging markets. And recently, some economists are arguing that high level of debt, it's not an issue, or it's not as an important issue as it used to be. My first question is, does it apply to MENA countries or not among the emerging markets? This is my first question to you. And my second related question, we are in a situation where the gross financing needs for the next 2 years will be in the vicinity of $1.1 trillion, coming up from 870 billion for the previous 2 years, which is an increase incremental of $300 billion. How do you see market responding to that? What are the red lights that markets will, or the key issues that market will look at when you look at this group of emerging markets from the region? What are the perspective from investors' standpoint? Is it different for the EMs of MENA or not? And is the debt an important issue, and how important is compared to the past? Amer.
Thank you very much, Jihad. And first of all, thank you for inviting me with this very distinguished panel. I'm already enjoying the discussion quite a bit. Jihad, you asked an extremely important question, which is, can we tolerate the high level of indebtedness that has been accrued and accumulated over the past 2 years? And indeed, since the great financial crisis, is that something that we need to be concerned about as investors? And let me be a little bit controversial here and say, and this is the essence of my answer to you, is we have a window, and that window is going to be measured by years, not months, in which the level of indebtedness that has been accumulated is less of a concern. But that eventually the reality will hit, and we need to be using this window that we're going through right now in order to deal with the problem down the road. So why do I say that the level of indebtedness among emerging markets is less of a concern right now? And why do I say that we have a window, a golden window of opportunity to deal with our structural problems, right? There are 3 reasons. First of all, debt levels matter, but only to the extent that debt servicing is impossible, right? So solvency and liquidity are 2 very different points. And in a world in which cost of funding is as low as it has been and likely to remain for the next 2 years, the fact that interest rates are as low as they are makes the ability of countries to tolerate the high level of indebtedness that much easier, right? I mean, you can be technical about it and think of it in net present value terms. The cash flows that you need to repay down the road mean less because you need to pay lower interest rates on them. So that's one important point. So long as interest rates are low, and given the anticipation that interest rates will remain low for multiple years, that provides ample room for countries to tolerate higher level of debt. A second and a very related important point, of course, is that the global low rates reflects the other side of the same coin, is an unbelievable amount of liquidity that is available out there. And that liquidity is nothing short of spectacular size, right? I mean, there is $38 trillion worth of short-term liquidity that exists in the markets today as a result of low rates globally and quantitative easing. That number, the 38 billion, went up by 10, from 28 to 38 in 18 months. The amount of liquidity that is available to buy and invest in emerging markets debt is unprecedented. And the third reason, of course, is that we are entering into a period of, and we have to be very honest about it, of unprecedented economic recovery for the next 18 months or so, driven by a post-vaccine normalization, by the amount of output gap that needs to be covered, and by the amount of fiscal easing that is occurring. And in that kind of world, in which economic recovery is going to be extremely strong for at least 18 months, the willingness of investors to buy debt of countries becomes higher. Right? As opposed to hiding that liquidity, you are willing to invest it in riskier assets. So low interest rates, enormous amounts of liquidity, strong growth. We do have a window here for emerging markets and a window for countries. However, and this is really the key point I wanted to leave with, is that that window is not open forever. Right? That window will eventually close. It will close once investors become nervous about the level of indebtedness, and once interest rates eventually go up, and they will go up eventually, right? And if one thing I know about my people here are the investors, is that we are very finicky, right? The volatility of flows to emerging markets is enormously high, right? We have the one standard deviation of flows into EM is $7 billion per month. We go in and out extremely aggressively, right? So at some point, if you wait long enough for a bus, the bus shows up. At some point, investors will be worried about the level of indebtedness. I'm arguing not soon. I'm arguing that within a year to a year and a half. And this is the time for the countries to embark on the kind of reforms and fiscal adjustment that is needed. This is the golden period for them to work on this in anticipation of the inevitable tension down the road. Let me stop there.
Amer, thank you very much. You have raised important issues that we will come later to discuss them, especially that how to seize this moment in order to address some of the structural weaknesses. But let me ask you a very quick question. Clearly, what you're saying is we are in an environment of more a push than a pull. Okay, investors are with the level of liquidity they enjoy today, ready to invest in emerging markets and ready to take the risk. In the case of MENA, we did a study a couple of years ago in 2018 that shows that although they are benefiting from this push factor and the recovery in capital flow was much steeper for portfolio flows than for FDIs, yet the VIX of issuers from MENA is almost the double of other EMs. What issuers could do, or what can be done for them to be perceived less risky than the average emerging markets from the perspective of investors?
Charles, obviously an extremely important and complicated question. Listen, first of all, by far the most important criteria is fundamentals, right? At the end of the day, investors are going to be attracted to creditors, to debtors whose creditworthiness is elevated. And that is a function we know what they are. It's a function of the level of debt, the debt service payment, the external environment, but it's also a function of structural reforms that ensure us as investors that eventually the capability of the country to raise the funding to pay us back is available. And that's about growth. That's about economic recovery. So countries should not just work on their balance sheets, on reducing indebtedness and improving the cash flow capability, the fiscal deficit, but also work on the kinds of reforms that lead to higher growth in the future that allows us to be paid down the road. And we will be distinguishing between countries who work on these two axes versus those who are just pushing the can down the road. Obviously, there's a second element of this discussion, which is beyond fundamentals, which is the technicals, which is something that often goes less discussed in policy circles, which is what I call the plumbing, the operational issues of taxation, liquidity, settlements, convertibility of the currency. Those also matter for us as investors when we look at the country in order to be pulled by that country. So fundamentals and technicals will distinguish the winners from the losers.
Amer, thank you very much. You gave me the best transition to now turn to Franco. Okay, Rafael and Amer mentioned two important dimensions going forward, that debt management strategy matters. The functioning of the debt market, the operational dimension, what Amer called it, the plumbery of the system, is important. I would like to ask you, as one who is at the realm of managing the debt, from the debt strategy, the middle office work, to the front office, as well as also to all the infrastructure. What are the lessons learned from Brazil's experience? And how do you see now, for you as a debt manager in the world of post-pandemic, where liquidity is high, investors are there, but also there are a certain number of very strong and important facts that needs to be also addressed. How you see the world of debt management changing? What are the priorities for you as a debt manager? And what are the lessons learned that you could share with countries in the Middle East and North Africa? For some are similar to Brazil, for some are a bit different, those who have maybe buffers and liquidities. What are the lessons learned in the post-COVID environment?
Okay, well, Jihad, thank you very much for the invitation. Good afternoon, everyone. Well, the situation we are in at this point, I mean, this crisis is clearly, credit negative, right? I mean, the world will have to live with more indebtedness, from most of the countries, no matter whether it's a mature economy or an emerging economy, low-income country, right? I mean, debt is rising in general, right? So, in the case of Brazil, I mean, just to give you a sense of this, to connect with the previous question, debt GDP level is around 100%, right? Which is a lot for an emerging economy, right? And we can discuss whether there is a limit or what's going to be this kind of threshold, right? I mean, what I usually say is the following: I mean, that will be sustainable as long as bondholders believe it is sustainable, right? So I mean, but besides having this, of course, this is the main indicator, that GDP level, that GDP ratio, right? But there are other very important characteristics, right? And other indicators, such as the how dependent debt issuance is from foreign investors, for instance, right? Or how dependent it is on just one type of investor, right? So I mean, it is very important to have a diversified investor base, right? In order to mitigate refinancing risks. Right, and in order to have a diversified investor base, right? I mean, we must have, a developed capital markets, right? And local capital market development, unfortunately, it's a medium-term goal, right? It does not depend only on debt managers, or it does not depend only on government. Right, there are many stakeholders. Right, it's a multiple task challenging. Right, I mean, the debt managers are involved, central banks are involved. Right, financial sector regulators are involved, the private sector are involved. Right, banks, mutual funds, pension funds. So I mean but anyway, I mean, we are, in the aftermath of this crisis, right? I mean, the pandemic, of course, is still around, right? I mean, the immunization process is taking longer than we all would like to, right? But anyway, in any crisis, presents also some opportunities, right? I mean, so having a more developed local capital markets, could be an opportunity. I mean, the crisis could be an opportunity to actually take measures to develop capital markets, right? And what I call exactly, developing capital markets, market infrastructure, right? I mean, having, sound custody and clearing systems, right? This is very, very important, right? In the case of Brazil, for instance, I mean, in spite of the fact that we have, such a high debt to GDP ratio, dependence on foreign investors is very low, right? So I mean, we account mainly on domestic investors, right? And with strong home bias, right? This is the main line of defense, right? So, and from I understood from your presentation and from the, the outstanding, report that IMF is, is publishing, MENA countries have, have been relying on local banks, right? And some of them have access to international markets as well, right? I mean, international markets, it's good, it's great to have access to international markets, right? I mean, usually tenor is higher, right? So refinancing risk, short-term refinancing risk could be somehow mitigated, right? But on the other hand, we have, more exposure to FX, which is a meaningful risk to be properly mitigated, right? And another point, regarding local capital market development, market makers. So I mean, having a sound primary dealer system, it provides liquidity, right? I mean, the liquidity is something that investors love. Right. I mean, whenever, what usually happens in local, in major economies, right, is that whenever there is need, the exit door, sometimes is too small, right? So, I mean, having a sound primary dealer system, sound market infrastructure, right, it provides liquidity, right, and it broadens investor base, right? But as I said before, this is a middle-term goal, right? But this, I mean, the impact of the crisis, I mean, the legacy, is going to stay for quite a while, right? So I mean, it is very, very important to take measures, right, in order to develop capital markets.
Jose, thank you very much. I have a certain number of questions. I'll come back to you. Let me first remind our participants at this webinar that they can ask their question on the chat box. And also they can ask their questions on our various social media. Let me do a second round of questions. We started having some questions that I will pass on to the speakers. And please, you could interject if you want to comment on what others are saying. Elena, let me get back to you. Of course, the issue that Jose Franco was explaining on how to establish sound debt management, diversify investor base, deepen the local markets. This is something that everybody believes in and aim to achieve as an issuer. And the deep and well-structured capital markets, local capital markets, is also a way for countries to insulate themselves from external shocks. Yet, the flip of the coin is most of the time you rely on few number of bondholders or financing sources that, if we take the case of MENA countries, the majority are commercial banks. And this is a trend that we saw accelerating in the past few years. How you see this from where you stand as risk, from a risk perspective? And what is the right, I would say, balance between relying on few deep pockets, which are in this case commercial banks, but yet concentrating the risks on their balance sheet, and using the opportunity that exists today to go into the international capital markets, but also, if markets return, face the risk that some EMs in the region went through in 2020, which is a massive and rapid outflow. What is the right balance? What are the lessons we learned from 2020 and the swing we saw maybe in Q2, Q3 in 2020?
Yes, we share this concern about the interlinkages between the sovereign and the banking system and the higher reliance on banking system funding for the sovereigns, for some of the sovereigns in the region. And we reflect the same concerns in our regional sovereign outlooks and also in our banking outlook as well. For example, in the Leuven and the North Africa region, we expect bank lending to the government to crowd out some of the private investment lending in some of the countries. In the GCC, on the other hand, where banks are generally resilient with strong capital and liquidity buffers, we see fiscal pressures on the sovereign as one of the key vulnerability to the GCC banks' credit profiles in 2021. So the linkages between the sovereign and the banking system creditworthiness are very important to recognize. And I'll explain how we view this from a sovereign risk perspective, and then I'll talk a little bit about what the historical defaults experience tell us about this. From a sovereign risk perspective, a domestic investor base is generally more stable, allows the sovereign to fund itself in local currency, allows for the debt to be issued under local law, and generally reduces liquidity risks for the sovereign. In a crisis, as we see some of this happening, a domestic investor base can provide a cushion and access to financing when external sources of funds dry out. But at the same time, increased holdings of government paper on the bank's balance sheet increases concentration risk for the banks and can weaken the banking system if sovereign creditworthiness deteriorates. And in a crisis, this could require the sovereign to have to recapitalize the banking system. So in our sovereign methodology, we incorporate both the positive and the negative effects of this. So we incorporate the positive effects in terms of liquidity risks and the negative effects in terms of increased risk of materialization of contingent liability for the sovereign. Additionally, the other channel, which is also very important in the current environment, is that if the banking system gets burdened by holding government debt to a point where it is no longer able to lend to the rest of the economy, the economic recovery will suffer. And again, this is especially important, and we are concerned about that happening in some of the North Africa countries, and it's especially important as we're trying to come out of this deep recession. In terms of the historical experience, we have a few stark examples of the importance of the sovereign banking sector linkages with the sovereign debt crisis 10 years ago, with the global financial crisis, which resulted in very slow and muted recovery, in part because of the pullback in bank credit to the economy. But I'll conclude with giving you a couple of examples from the sovereign defaults experience, and that provides another perspective. In the last 30 years or so, there have been 42 sovereign bond defaults. So 42 sovereign bond defaults since 1997. In 1/3 of the cases, so 33% of defaults, were accompanied by systemic banking crisis. So not just banking sector problems, but systemic banking crisis. In slightly less than half of the cases, the banking crisis triggered the sovereign default. In slightly more than half of the cases, the banking default triggered the sovereign default triggered a banking crisis. So about half banking crisis causing a sovereign default, and sovereign defaults triggering a banking crisis. So history shows that relying on bank financing has been a useful emergency tools. But history also clearly points out the limits to bank financing. So I'll stop here. Thank you.
Thank you very much, Elena. Let me turn to Jose Franco. And following on what Amer said and what Elena just said now, in 2013, during the taper tantrum, Brazil was vulnerable at the time, and you took certain number of both immediate measures and later a certain number of deeper reform. Let me ask you two questions. One is, what is the role of fiscal policy and debt management based on your experience, and how fiscal policy and debt management should play in reducing and managing the risks and the level of debt? Amer was mentioning that also you need to address the balance sheet, but also you need to strengthen your growth fundamentals. Otherwise, it will be pain without gain. What, based on your experience, one could learn in a region where 60% of countries are at the level of debt that exceeds 70% of GDPs, and where in 2020, most of them had to endure negative growth. What are the fundamental reforms that you see here for those countries to strengthen and to manage the next crisis or the next volatility in markets that will come one day?
Well, Jihad, this is a very, very good point, right? I mean, I guess given that the situation that we are in, right now, when I mean most of the countries, around the world, right? I mean, it is very important, to anchor medium-term expectations, right? I mean, the short term, I mean, governments have to spend more, right, to provide more fiscal stimuli. Of course, I mean, there are different countries, right? I mean, some of them have more fiscal space, some have less fiscal space, right? But in the short term, there is not much that could be done, right? But it's very important to anchor a medium to long-term expectations, right? And then we come to fiscal policy, right? I mean, it depending on the country, of course. I mean, it is important to have a fiscal anchor, right? It's not in the short term, at least in the medium term, right? And going direct to your question, trying to answer it very directly. Back in 2013, during the taper tantrum, I mean, Brazil was in quite a difficult fiscal situation, right? Brazil still is, right? But at least after 2016, the government of Brazil, created a new fiscal anchor, which is the spending cap, right? It's a fiscal rule, right? I mean, fiscal rules are not a panacea, right? I mean, but at least they create guidelines, and government has to respect this rule, right? And it was very, very important to anchor medium-term expectations, right? This is from the from fiscal policy standpoint, right? From the this debt management standpoint, having a sound medium-term debt strategy, right, will also be very useful to anchor medium-term expectations, right? I mean, and of course, I mean, communication is key, right? So I mean, during any period of crisis, I mean, the IR unity, has a very, very important role to play, right? So improve communication with rating agencies, right? The improve communication with the investor community, right? Uncertainty, is translated into risk premium, right? So I mean, improving communication, even if you do not have necessarily any, a positive thing to say, right? I mean, you say what you have to say, right? But gaining credibility, right, will pay off, right? Economic recovery will be key as well, right? I mean, the countries will have a different stage of economic recovery, but regarding this the possibility of having more tight financial conditions internationally. It will happen at some point in time, right? I mean, but in the case of, I would like to mention another example, right? I mean, after an excess of international liquidity, after a period of international excess of liquidity, that will be definitely, a period of tighter financial conditions, right? We may not know when exactly, but this time will come, right? The situation we have at this point, the treasury yields, the 10 years, for instance, a few months ago was at around, 0.9, 0.8. Now, for this year, it had already reached, 1.8, right? So, I mean, it stabilized somehow, right? But it was a signal, right? I mean, this tighter financial conditions will come at some point, right? And in the case of, just to provide you another example that was quite traumatic, for Latin America, which is the region where I come from, during the 70s, back in 1970s, after a period of low interest rates in the US and most of the other mature economies, Latin America countries, raised a lot of cash with internationally, right, with index to LIBOR, the floating interest rates. Right, and then came the Volcker era. Right, Volcker was the former U.S. Fed governor. Right, and he really fought inflation, rising interest rates, and the result was that many countries in Latin America, including Brazil, defaulted on their external debt. Right, so I mean the history is plenty of examples. Of these types of, having tighter financial conditions after, a period of excess of international liquidity. And, that's why I'm saying that it is very important, to anchor long-term expectations, right? To have a sound medium-term debt strategy, right, and create the appropriate hedges for this situation when it will come.
Jose, thank you very much. Amer, let me go again to you. Issuers usually during ample liquidity moments work extensively on attracting long-term investors to their local market. Which is always a challenge because most of the investment in local currency bonds is short-term. And sometimes the carry trade is what drives foreign investors. What, in the case of MENA countries now, could be for them a way to attract further long-term investors in their local markets? Is it the introduction into international indices? Is it by changing certain number of regulations? What would make markets more attractive for longer term investment in the local currency for them to reduce the risk of mismatch?
Thanks for this question. So first of all, if you don't mind, what I'm going to do is I'm going to separate a little bit what I would call the riskier part of the MENA region, the higher yielding, sort of sub-investment grade kind of countries, and keep the GCC on the side. Right? GCC is a very interesting story, which I want to get back to eventually, right? And before I talk about the riskier countries, allow me to make a broader point about local markets and investments in local currency bonds in emerging markets. And this is not just about MENA. This is a broader point I wanted to make, which is that that's part of the asset class, that investment in local bonds in EM has been in a bear market. This is beyond just EM. This is beyond just the MENA. Most other emerging market countries have suffered from their ability to attract local markets. The heydays of 2004 to 2008 is behind us. And just to give you a sense of what I'm talking about here, between taper tantrum, so 2013 and 2019, flows into local markets in EM were actually negative. There were money that left EM rather than came in for 11 years. Now, admittedly, since then, we've had a bit of now we're back into positive, but compare that to hard currency investments, which are up $500 billion. Local market investments are barely up over this longer period of time. And listen, there's one main reason, right? There's multiple reasons, but really the one that matters, which is when you're investing in local markets, Jihad, you're investing in you're taking FX risk. You're taking the risk of the currency being paid back in dollars. You invest in local currency, but you need to be paid back in your currency, which is the dollar. And if you look at the basket of EM FX, right, since actually 2011, not even before the taper tantrum, we're down. That basket would have lost you 60%. You've lost 6% of your capital as a result of the exchange rate depreciation that we've seen over the past 10 years or so, right? So the point that I'm making is that if you are investing in local markets, you need to care about an FX risk, and the FX has been over the past 10, 11 years a very bad investment in emerging markets. Which brings me back to MENA, right? Sort of thinking of Lebanon and Egypt and Morocco and Pakistan, all of whom are countries that are trying to attract capital in local markets. But the reality is they're fighting a bear market in that asset class, and it's very difficult to attract that kind of investments in a world in which flows are leaving that part of the asset class. Could they do something? Of course they can, right? If you work on your fundamentals, if you work on your technicals, on your sort of the what I refer to as operational, the plumbing side, if you join the indices, if you create a yield curve, so you're no longer just providing investment opportunities in the front end, but also in the long end, all of this will help. But the broader point I want to make is that the context for local market investment is no longer as positive as we thought 20 years ago. 2 minutes or even less on the GCC. That's not the problem with the GCC, right? The GCC is the perfect sort of perfect environment for attracting local market instruments. They have a fixed exchange rate regime. It's a fairly liquid market, extremely high level credit worthiness, so you're not worried about being repaid. The problem with the GCC local markets is valuations. Interest rates that you can get on local bonds is too low relative to what you can get in other countries, but also relative to their dollar debt. So let me stop there.
Amer, thank you very much. Let me build on where you ended and go to Rafael. Rafael, you started your presentation talking about the importance of debt management strategies. Clearly, we are in a situation where some are thinking about active debt management transactions, how to benefit from the current liquidity to address and mitigate some of the rollover or refinancing risks by doing proactive liability management. Based on your interaction with the sovereign issuers in the emerging market arena, and also based on how you see the macro evolving for developing countries and emerging markets, and how you see the investor appetite, what would be your recommendations in the case of the countries in Middle East and North Africa, especially the EMs, where they have high level of debt that Big chunk of it is short-term or shorter-term, especially because it's denominated in local currencies. What you recommend for those issuers in terms of liability management, in terms of adjusting their strategies to benefit from this window of opportunity without being caught later on by the change in market sentiment?
Thank you, Jihad. I want to take a page of Amer's sort of what he would talk about. So we talk about basically the fundamentals and the plumbing. So basically the strategy and the implementation. And I think the first thing I'll say is that I think Jose Franco already outlined many of the important things about debt management that he has to discuss. And I think that that's one issue that we need to understand. What does markets and sort of investors look for in terms of when they're looking to invest? And when you want to create some sort of an environment where you want to foster and foment sort of investment. And there's three things that I can think of. One is predictability of policy, transparency of data, and number three, confidence in your policy that you're created for any government that is doing that. So as Jose Franco was saying, in terms of all the different things about debt management, there is one thing that I think is very important, which is basically is that in the aftermath of COVID-19, I think what is becoming clear, at least for all of us, and what we recommend in general for every country, not just the MENA region, but every country in the world, is that debt management needs to continue to evolve. And to some extent, it needs to become part of a country's macroeconomic policy framework. So in debt managers need to work independently, of course. You have to continue to have independence between the three different sort of policies, but they need to cooperate and they need to coordinate among themselves to be able to create these three aspects of an environment that we talked about. So they need to work closely together. It's impossible. I mean, debt managers, the risk for debt managers is not only to raise funding and to record and report, but to understand risks and how to manage those risks. And to manage risk, you have to be able to measure the risk and to be able to understand how you can manage it. Liability management operations are very important. And there are many countries in the world, they're not the developed nations, that are very proactively managing the yield curves in a very, very effective way. The Philippines and Indonesia, for example, in Asia, in Latin America, Brazil, Colombia, and Mexico are well known for their abilities to manage their yield curves very effectively. And because they spent the time to develop those policy mixes and at the same time to create the right environment. So the question you're asking me now, and I want to basically perhaps I'll take a little bit of liberty here, is that it's not just looking about what can we do now, is that what happens if you lose market access? What happens, like we were talking about, the level of indebtedness is so high that you lost confidence in your investor base, and then you find yourself, but no other way if you have to restructure your debts. And I think that's where a lot of investors, a lot of market participants are very concerned about in this potential wave of sovereign debt restructurings. So instead of going to try to replicate a lot of what Jose Franco had now said about medium-term debt management, development of capital markets, which are very important, the right systems, ensuring that you have a communication strategy, an investor relations strategy to disseminate and to create transparency, because investors want to be able to have, they don't want to see, they want certainty. They want to know exactly where they're going. But if you have to restructure your debts, what are the lessons? What can you do? What can a country do if that is the case? And I highlighted, I'm just going to share my screen just for a minute, because I thought about this a little bit. And just in case that you were going to ask me a question like that, just to complement, can you see my screen right now? No, sorry, technical problems. Very quickly, I will basically say, there are 7 things that people can think about. The first thing is that if a sovereign needs to restructure its debts, if that's the situation, the first thing they need to understand is that they need to understand what causes the situation beyond COVID-19. COVID-19 is a symptom of the situation, right? Sorry, not a symptom, it's worsening the situation. But countries who had the economic imbalances are faring worse than others. So if you need to restructure your debts, understand what your economic imbalances are and how are you going to address those imbalances. So understanding the challenges are important, and you have to develop credible economic reforms. That cannot be stressed enough. The second thing is that a sovereign debt restructuring in isolation is not the panacea. That's not the solution to a problem for any sovereign. If you have to structure your debt, do it as a complement to the economic reform program that you're going to develop. Because if you're going to look at, we can go and look at examples between Ecuador and Argentina and many other countries, Lebanon, for example, is that they can't pay their debts, but they have economic problems they need to address before they can even restructure their debts. So going to restructure your debts without understanding what your problems are, incredible reforms is not going to make a difference. That means that if you're going to do that, you need to go find help. The first point of venue, the first point of call is the multilateral organizations, because they're critical stakeholders and they can support the reform agendas via financing, technical assistance, and building capacity when they need it. But what's more important is that if you are going to restructure your debts, you're going to go and reach out to your creditors, having multilateral support like from the IMF creates accountability. They know that there is something that the country is going to commit to those reforms, and they'll be able to follow through over the life of the program. So that's an important aspect that people always sometimes seem to forget. Going back to what Jose was saying, you need to develop a comprehensive medium-term debt management strategy, or MTDS for short. The why is important is because you start to create a strategy for the long term. You have to restructure your debts today, yes, but how are you going to move to sustainability, and how are you going to maintain those policies? Transparency, data dissemination is very important, which is why if you are going to reach out to your creditors, that makes the next point is that you have to engage them. Creditors are not just to be squeezed for any reason. Yes, there's a lot of very wealthy investors who take advantage of the situation through vulture funds, but in general, the way Amer was talking about it, there are mostly mutual funds, pension funds who invest, and they're the ones who are going to be losing their money as well. There's a knockoff effect at that point. So if you're going to go there, engage early with them in a transparent manner, think of them as stakeholders, and basically share the information. Show them what you're doing and get them to support your reform program. If they're going to provide debt relief is a support program to the reforms. I think that two more things, every country has to restructure their debts. They're unique in the situation. So sometimes there's not a lot of people in the sovereign debt field who are debt managers who restructure their debts all the time. So if you're actually going to have to do it, bring in legal advisors and financial advisors who can actually help you, who know what they're doing. But be careful, because strategies matter. If you're going to go there, take an adversarial tone, you can see a situation of protracted default. And the IMF has a lot of resources to basically quantify the implications of a protracted default. And then finally, process matters. If you're going to restructure your debts, you have to do that because you find yourself in a crisis situation and you have not have market access, you lost everything else. You have to create a situation where you can engage early, you can share information, you have the multilaterals, and you actually create a process that creates inter-creditor equity, so that people don't feel there's no one group of creditors who say you're taking advantage of me, but there's burden sharing across the board.
Rafael, thank you very much. We are receiving a lot of questions. Let me maybe now turn to the questions we received. I have the first question from H. Edez. We received this via Zoom chat. Don't you think that the threshold of debt ratio for EMs at 70% should be raised to take into account the non-avoidable impact of the COVID crisis? I would like to ask Elena quickly for her views on that, and also maybe ask Amer, what is your level of tolerance as an investor to that? Elena.
Maybe I start from a credit perspective, from a credit ratings perspective. For us, the debt ratio in terms of debt to GDP is less important. So we look at the rank ordering of countries across. So it's really the relative rank orderings that matters, not the absolute level in terms of debt. But also we found that, if you look at the historical defaults experience, things like debt servicing costs, so interest payments to revenue, measures of debt affordability are more correlated with sovereign default risk than it's actual debt to GDP levels. So when we look at the sovereign balance sheet, we look at the structure of the debt maturity profile, the share of foreign currency debt, the external versus domestic investor base, and a wide variety of measures, not just the driver for in terms of debt to GDP ratios. There's one case where I do think that it does matter, the current environment that matters, and that's it's more true for advanced economies than it is for emerging markets. If you look at, because interest rates have been on a declining trend for 3 decades now, since the 1980s, when you look at advanced economies, even though they're experiencing some of the bigger increases in debt levels, the debt servicing costs, the aggregate debt servicing costs are still coming down. They've been coming down for a decade and they continue to come down. And that comes from the fact that they're funding new debt as at a lower interest rates than the average interest rate on the debt stock. But for many of the emerging markets, that doesn't hold. If you look at the emerging markets, as debt levels, they're still, for a lot of them, they're still funding at lower rates than a few years ago. But because of the increases in that trajectory is starting to turn. So debt affordability is actually turning the wrong way. And the MENA region is the last one I make, but the MENA region is one of the more affected. So if you look at interest payments to revenue, they've moved from something like 4% back in 2010 to now reaching around 10% over the next couple of years. So it's a very large increase in interest payments to revenue for the MENA region in particular. And it's more than what we see in terms of the median debt servicing costs compared to Asia or Latin or emerging Europe.
Thank you very much, Elena. Amer, I would like to ask you, what is your ratio of debt tolerance as an investor? And add another question. This is, what is, for you as an investor, the difference between a country coming to the market with an IMF program and a country coming to the market without an IMF program in the region or in the EM arena?
So I'm struggling whether I should or should not give the example of what the Supreme Court in the US said about, I might as well say it, about porno, which is that you cannot define porno, but you know it when you see it. And that's really the best way of thinking about debt, right? You don't know how high is high, right? Until you get to a certain point where investors sort of step back and say, this is unsustainable, this is impossible for them to be repaid. You get into this liquidity crunch, you run away from the country, you refuse to refinance their debt, and that's when the debt that's when you actually restructure, right? So my first point is that you don't know until you know, and it's very difficult to be too precise about it ex ante, which from a policy maker's point of view, and this is what Franco would talk about, I'm sure, means you don't fall into what I would refer to as a type 2 error. You don't push your luck, right? You don't go too far, right? You try to push the envelope, but you know that at some point you're going to run into difficulty. You should try to stop before the problem develops, not when the actual problem develops, right? So that's a very broad point. But now let me be slightly more specific and say the other axis when you think about this problem of what is the level of debt tolerance is that not all countries are created equal, right? I am perfectly happy with a Chile with a debt to GDP north of 100%, but I would feel extremely uncomfortable with a 30% of GDP debt in Yemen, to take the complete other example, right? So the countries matter in which, and that becomes very much a function of the other things that matter, the ability to the ability to correct the fiscal, the external accounts, the level of interest rates that they have to pay. Most importantly, growth, the ability to generate the cash flow to repay the debt. So my second point is it really matters which country you're looking at. The third point, and that's a point I made before, which is that we're living in a golden age right now because of low interest rates globally and ample liquidity that allows us, all things the same, to tolerate slightly higher level of indebtedness today than we did a few years ago because of lower global rates. But that story will finish at some point. At some point, rates will rise. And the tolerance that we have right now for that will shift down as interest rates globally go up again. So I cannot define it. Depends on the country. And it looks like we can tolerate high level of indebtedness right now. But within a couple of years, we are going to be shifting down our tolerance as interest rates go higher globally. I don't know if that answers your questions. Yeah.
Perhaps I.
But I had another question that maybe you did not answer is, does it make a difference if the country has an IMF program or not? And then I'll give the floor to Rafael.
Well, I'm biased because I still consider myself a son of that institution. Yes, and with it comes multiple. The reason why the IMF matters is for multiple reasons. One, it comes with money. They are the umbrella through which every country can get money. They are the entry point. We can't get money from the bilaterals, from multilaterals, from other investors unless the fund gives a stamp of approval. Two, a fund program provides you with a macro framework that is understandable, articulated, and you look at the medium-term anchor that Franco was talking about. And three, the credibility of a sheriff, of a policeman who watches you and makes sure that, unfortunately, by the time the IMF comes, there's a credibility in the policymaker of the policymakers. So the fund at least is a watchdog for you. So certainly it makes a difference for me.
Thank you very much, Amer. Rafael, you wanted to comment on.
I do want to comment because I think that Amer is absolutely right. I think that market participants get too dragged down on the debt to GDP ratio, but one ratio alone does not define sustainability of a country's payment capacity. I think for me, what is helpful sometimes when you have an IMF program is that you define a target in order to be able to implement the policies you're going to get to that level. But for me, what really matters is the path of primary surpluses that will define whether or not you're able to raise enough money to support the debt that you actually have, another debt service. So for me, from a technical perspective, as a debt advisor doing this for the last 20 years, I always advise my countries that I'm working with, let's not even focus on what level you can have. Just focus on primary surpluses. Can you maintain the primary surpluses? Can you afford the interest that you're paying? And how long can you continue to be able to roll over your debt? At the end of the day, liquidity and solvency, like Amer mentioned it before, and like Franco was talking about it as well, is a very fine line. If you lose confidence, you can move from become a very liquidity country to an insolvent country very quickly.
Thank you very much, Rafael. There is another second question coming from Yumna that came via Zoom. Yumna is asking, how do you see the impact of possible Fed hikes to be sooner than EM hikes due to a faster economic recovery in the US on MENA sovereign debt risk portfolio? And will you see another 2013 tantrum? Let me ask this question to Franco. Is this question keeping you awake at night or not? Are you afraid of premature or earlier, I don't know what earlier means, hike in Fed rates? And then maybe whoever wants to comment on how do you see the impact on MENA? Franco, are you awake at night because of that?
This is, one risk on my radar, to be very honest with you, but not for 2021. Right. I mean, it will come at some point, right? I mean, as I said before, the surprise that we had early this year was a kind of warning. Right. I mean, for this year, for 2021, it is a tail risk. Right. But it will happen sometime in the future. Right. And in the case of Brazil, consider that we have a low dependence on foreign investors. The impact might not be that huge, but there will be some impact. right? I mean, no matter, asset prices are correlated, right? So I mean, an increase in the interest rates in mature economies, will be followed, probably instantaneously by a high interest rate in local markets, right? I mean, in the case of Brazil, we have high exposure to local rates, to the basic interest rate. So I mean, this will be the main channel, right? But anyway, it's talking, about sustainability or solvency. I mean, it's important to have those two main variables. I mean, GDP growth and real interest rates, right? I mean, as far as GDP growth is higher than the interest rate, so you are in a good situation. That's the general rule, right? I mean, in this situation, when the Fed, starts hiking, starts the hiking cycle, right? I mean, the real interest rate will grow, right? So this is something to care about and to pay attention, right? But all the debt managers from emerging economies, should be prepared, should getting prepared for the situation when it will come, right? I mean, what could be risk mitigating factors? I don't know. I mean, liquidity buffer, right? I mean, all those liability management transactions. I mean, hedge somehow the FX risk, right? I mean, we should be prepared. The situation will come at some point in the future.
Thank you very much. We are rapidly exhausting our time. Let me do a final round, last call, starting from Elena. Elena, what would be for you in the next 12 to 18 months the key issues to watch when it comes to EMs, when it comes to MENA? And then we'll continue the tour.
I think I'll take this on the economic side. The pandemic is still in the driving seat as far as the recovery goes. So I think there is light at the end of the tunnel. The economy is recovering, vaccination is proceeding very uneven across countries, but it's moving slowly along. But we are still in the tunnel, and it's a very sort of cautiously optimistic tone that I'll take on this. We are still in the tunnel, and it's a long tunnel for a lot of countries. So still a lot of uncertainty ahead.
Thank you. Rafael, what are the key priorities, especially in terms of fiscal and macroeconomic policies?
I think that you can probably guess what I'm going to say. I think that debt management, sovereign debt management, is key. Amer made a really good case about how we're going to see a massive recovery in the developed world. I don't see that in the emerging markets. I think that's going to be very uneven in emerging markets because of the issues related to vaccination, rollout of vaccinations, concern about sustainability, concern about the debt levels. But there is going to be an opportunity for countries that are resource exporters to be able to take advantage of that opportunity. And I think MENA countries have that. Some of those countries will have that opportunity. And so, but for me, what I like to continue to see is the countries focusing on some of the things we discussed here today that Franco, discussed in detail about capital market development, diversification of funding sources. And that's what I like to see: communication strategies and enhancing transparency. Those are the things that the region is still grappling with. And I still see that it's something that they need to continue to work in the next 15 years, particularly now because of the pandemic.
Franco, if you are meeting with your colleagues from MENA debt managers, what would you tell them based on your experience, especially that also COVID-19 is affecting Brazil heavily this year?
Well, I guess, coordination between, debt management, fiscal policy, and, liquidity management, which is, a rule from the central bank. I mean, coordination among authorities is going to be key. right? And as I said before, I mean, every crisis, provides opportunities, right? I mean, it is an opportunity. I mean, debt managers are aware of the importance of, developing local capital markets, right? But it is quite challenging. As I said before, there are too many stakeholders, right? I mean, it is an opportunity, to get the main players, around the same table, and to actually, design a comprehensive strategy, right? To be prepared for what's coming in the next few years.
Thank you very much, Amer. We saw last year countries losing access to market, MENA countries losing access to market like other EMs, but regaining it fast. So cases where, in fact, the level of subscription, the level of spreads that some of the issuers were able to get from the market, the maturities, were relatively, I would say, even in certain cases, better than what they were able to access prior to the COVID shock. How countries, what are your recommendations to issuers to maintain good access to market in the next 12 to 18 months? What are the policies they should do? What would make you and the investor community comfortable investing in issuance of bonds or other type of paper from issuers from the region, both the group of EMs, the Egypt, Jordan, Morocco, and others, but also I would say the high rating ones, the GCC. What are your recommendations to them for the next 12 to 18 months?
No, absolutely. And I think the example that you gave, the episode you gave, is a very good microcosm of the boom-bust scenario that emerging markets often experience, right? Over the part, sort of, we get sudden stops and then massive inflows, and then sudden stops and massive inflows. And it's important to try to highlight the factors that to predict the sudden stop and to benefit from the periods of inflows in order to ensure that when the sudden stop shows up again, you're prepared. And there are 4 things, and I'll be extremely brief, that each country needs to be focused on. 2 are external, 2 are domestic, right? The external ones, every EM shock and crisis happens as a result of higher global rates, right? Higher global rates, tighter liquidity, major markets. We're still years away. I agree with Franco. I think we're 2 years away from seeing that, but this is something we need to start preparing, hedging ourselves against. Second is global recessions. Global recessions are the second huge enemy of emerging markets as well, mainly through the commodity cycle, price cycle, but in general, their export markets, remittances, hurts them as well. Again, I'm very comfortable that we have a runway for 2 years on that one, but that's not going to be forever. Eventually, the global economy slows down, and that hurts us. So start hedging, start preparing for the inevitable bus crash coming down the road. 2 domestic factors. And this is particularly about the MENA region. Our growth rates have shifted lower. Right? We have a lower trend growth in the past 10 years for multiple reasons. We need to raise it again. Structural reforms that allows us to bring back the level of activity that generates the kinds of revenues that allows investors to feel comfortable they're going to be paid, extremely important. 2, we haven't spoken about it at all, but quite important in the region, politics. We're living through a very difficult period of adjustment, lower growth, and sort of political instability is the other enemy of investors. So again, it's not a recommendation, it's more of an observation, but politics will matter.
Amer, thank you very much. I totally agree with you, and I think this is maybe what is reflected in the volatility and in the VIX that the countries in the region are having, even those with the same level of rating. Let me thank you all for an outstanding discussion on an important topic. It was, I would say, one of those outstanding combination of talent who covered different dimensions of this issue. I would not pretend that with the time left, I would take the risk to summarize what has been said. But again, I think clearly it's not only one dimension that would play a role. A macroeconomic stability is key, and it starts with having the right policy set, fiscal and monetary policies, and then moving to having also the right management of the liabilities, and for countries who have assets, have the right management of the balance sheet. Confidence and engaging with clear strategy, also clearly based on what I have been hearing throughout our discussion, plays an important role. Last but not the least, you need to keep an eye on what's happening globally, because in fact, global or external factors are even more important than the one you have internally. Therefore, you need to worry about yourself, but also to worry about others, especially when you are a medium-sized or small-sized emerging economy. You have to be careful about the winds, and when winds turn, you have to be ready to be protected for that. Again, thank you very much for taking the time. I would again thank all who have participated with us, those who have asked questions. You could go back to the chapter that we have recently published in the context of our regional economic outlook update, where we have additional analysis and details on these issues that complement our reading to the outlook for 2021, which is, we thought that 2020 was an exceptional one. I feel that 2021 is going to be even more challenging and interesting. It's always a pleasure to be with you guys, Elena, Franco, Amer, and thank you very much for staying with us. Thank you very much for participating, and see you soon. Bye-bye.